If I could give my younger self one advantage, it wouldn't be knowledge of future prices. It wouldn't be capital, connections, or luck. It would be the ability to feel nothing, to watch a position move against me and feel nothing, to see others get rich while I wait and feel nothing. Because the man who can master his pulse in the face of opportunity and disaster, that man owns time itself. And time is the only edge that still exists in a world where everyone sees the same chart at the same second. You've been lied to. Not maliciously, perhaps, but lied to nonetheless. You've been told that trading is about finding the right stocks, the right indicators, the right strategy, that if you just study harder, backtest longer, or follow the right guru, you'll crack the code. But there is no code. There's only human nature, and human nature hasn't changed since I walked onto the floor of the bucket shops in 1892. What has changed is the speed at which you can destroy yourself. In my day, you had time to think between quotes. You had friction. You had the physical act of placing an order that forced a moment of pause. Today, you have none of that. You have a button, an instant fill, and a dopamine loop designed to keep you acting when you should be waiting. You're exhausted, aren't you? You're oscillating between euphoria and shame. You're making money and losing it back. You're trapped in a cycle where every win convinces you that you finally figured it out, and every loss whispers that you're not smart enough, disciplined enough, or deserving enough. You're trying to control the market when the only thing you can control is yourself, and that's what we're going to talk about today. Not how to predict the future, not how to find the next 10-bagger, but how to survive the present, how to build yourself into an operator instead of a gambler. If I started trading today, I wouldn't try to win. I'd try to learn not to lose. Because the trader who knows how to lose small and wait long will outlast the genius who's right 11 times and wrong once. This isn't about motivation. It's about construction. We're going to build you into something different, something better, something that can withstand the pressure of real money on the line. I'm not going to teach you patterns. I'm going to teach you patience. I'm not going to give you setups. I'm going to give you principles. And I'm not going to promise you wealth. I'm going to promise you clarity, because clarity is the only thing that survives volatility. Now let me tell you a story. I was 14 when I first walked into a bucket shop in Payers, Massachusetts. I had no money, no education beyond basic arithmetic, and no understanding of what a stock even was. But I had something else. I had no opinions. I'd stand there for hours watching the board, watching prices move, and I'd notice things. Small things. The way a stock would hesitate before it ran. The way volume would dry up before a reversal. The way certain numbers appeared over and over at certain times. I wasn't trying to be smart. I was just trying to see. The older men, they'd argue. They'd debate. They'd explain to each other why this had to happen or why that was impossible. And then the tape would prove them wrong. Every single time, the tape would prove them wrong. Not because they were stupid, but because they were operating from belief instead of observation. I made my first trade at 15. I risked $5, borrowed, and I made $3 in profit. The older men laughed. $3, they said. Big operator. But I didn't care, because I'd done something they hadn't. I'd waited until I saw the setup I'd been watching for. I didn't trade because I wanted to. I traded because the conditions told me to. If I started today, I'd do the same thing. I wouldn't open a brokerage account for 6 months. I'd watch. I'd paper trade. Not to practice execution, but to practice waiting. To practice seeing the setup, form, and then watching it play out, or not play out, so I could learn what the market actually does versus what I think it should do. You see, most traders start backwards. They start with the action, the trade, and then try to build observation around it. But observation must come first, because if you don't know what you're looking at, you can't know when to act, and the market will punish you for every premature move. It will take your money with the efficiency of a pickpocket in a crowd, and you won't even know it's happening until your account is empty. Let me tell you about another man. Years later, after I'd made my first fortune and lost it, I met a trader. Let's call him Turner. Turner was sharp. He could read a chart better than anyone I knew. He'd call the turns, sometimes to the day, but he couldn't hold. He'd get in right, but then he'd get out too soon. He'd take 5 points when there were 50 to be had, and he'd tell me, "Jesse, I just can't stand the pressure. What if it reverses? What if I give it all back? And I'd tell him, Turner, you're not trading the market. You're trading your fear. See, Turner had learned to be right, but he'd never learned to be big. He thought trading was about entries. But trading is about sitting. It's about the ability to do nothing while you're in profit, while the stock reacts, while it digests, while weak hands sell and strong hands accumulate. The money isn't made in the buying or the selling. It's made in the holding. If I started today, I'd build one skill above all others, the ability to sit, to hold a position when every instinct screams at me to take profit, to add to a winner instead of a loser, to let the market prove me right before I start pyramiding, and then to ride that wave until the market itself, not my fear, not my greed, tells me it's over. Now, what does this mean for you? It means that if you want to trade like an operator, you need to understand some core principles, principles that separate the Sebastian of Henry, professional, from the gambler, principles that have nothing to do with technical indicators or chart patterns and everything to do with how you think, how you feel, and how you act when money is on the line. Let's start with the hardest truth. The market is never wrong. You are. Let me say that again because I know it stings. The market is never wrong. You are. You are not smarter than the market. You never will be. The market is the aggregate judgment of millions of participants, each with their own information, bias, and capital. You are one person with a screen and an opinion. When your position moves against you, the market isn't confused. You are. I learned this the hard way. In 1906, I was short the market. I had every reason to be short. Things looked bad. Fundamentals were deteriorating. Sentiment was shifting. But the market kept going up, and I kept adding to my shorts, convinced that I was right and the market was wrong. I lost everything. Not because I was a bad trader, but because I was arguing with reality. You cannot argue with reality. You cannot impose your will on the market. The market doesn't care what you think. It doesn't care about your analysis, your thesis, your conviction. It only cares about supply and demand, fear and greed, the collective psychology of everyone who's putting capital at risk at that exact moment. And if you're standing in front of that train, telling yourself you're right and the market is wrong, the market will run you over without slowing down. If I started today, my first rule would be this: the market's action is the only truth, not the news, not the analysis, not what some expert says on television. If you're long and the stock is going down, you're wrong. If you're short and it's going up, you're wrong. Your job is not to be right. Your job is to align yourself with what is, not what you think should be. This requires a kind of humility that most people don't have, because we're all walking around with these stories in our heads about how the world works, about what's fair, about what makes sense. And when the market contradicts those stories, we have two choices. We can change our position, or we can change our story to justify staying in a losing position. And I'll tell you right now, the second choice will destroy you. I've seen it 1,000 times. A man buys a stock at $50. It drops to 45. He tells himself it's just a pullback. It drops to 40. He tells himself it's a buying opportunity. It drops to 35. He tells himself the market is irrational, and eventually it will come back. And maybe it does come back. But by then, he's so underwater, so emotionally exhausted, that he sells at 43, taking a loss right before it runs to 60. And then he tells himself he's unlucky. But it's not luck. It's a failure to accept what the market is telling him. The market was saying, from the moment the stock dropped below his entry, you're wrong. Get out. Take the small loss. Wait for a better opportunity. But he couldn't hear it because his ego was too loud. If I started today, I'd train myself to hear the market, to listen to price action, to volume, to the way a stock behaves under pressure. And when the market tells me I'm wrong, I'd get out. Not because I'm weak, but because I'm smart enough to know that my capital is more valuable than my pride. Now let's talk about timing. Timing is everything. And timing requires patience. Here's a paradox. The less you trade, the more you make. I know that sounds backward in a world that rewards action, but it's the truest thing I can tell you. The big money is not made in buying and selling. It's made in the waiting. I've watched men sit through entire bear markets, cash in hand, waiting for the turn. And when that turn came, when the market finally gave the signal, they'd step in with size and ride the entire bull move. Then I've watched other men trade every wiggle, every rumor, every pullback, trying to squeeze pennies out of noise. The first group got rich. The second group stayed broke. Why? Because the market only offers a handful of real opportunities each year, moves that are big, clear, and sustained. Everything else is chop, and chop kills. It kills through commissions, through slippage, through the emotional exhaustion of being wrong 6 times before you're right once. If I started today, I'd wait. I'd wait for the setup that screams at me, the one where the trend is clear, the volume is confirming, the resistance is broken, and the path of least resistance is obvious. I wouldn't trade to feel productive. I'd trade to be right. And being right means waiting until the market makes it easy. You know what's interesting? The amateur thinks the professional is always in a trade, always active, always doing something. But the professional spends most of his time doing nothing. He's watching, analyzing, preparing, and then, when the moment is right, he acts with conviction. He doesn't nibble. He doesn't test the waters. He steps in with size because he's waited long enough to know that the odds are in his favor. This is the part that kills most traders. The waiting. Because waiting feels like losing. When you're sitting in cash and the market is moving, you feel like you're missing out. You feel like you're being left behind. And that feeling, that fear of missing out, will make you do stupid things. It will make you chase. It will make you trade setups that aren't quite right. It will make you enter at the wrong time, in the wrong stock, with the wrong position size, just so you can feel like you're participating. But participation is not the goal. Profit is the goal. And profit comes from patience, from the ability to sit still while opportunity develops, from the discipline to wait for your pitch instead of swinging at everything that comes near the plate. If I started today, I'd make a rule. I would only take trades that meet my criteria, not trades that are close to my criteria, not trades that might work out, trades that meet my exact criteria. And if that means I only take 5 trades in a year, so be it. Because those 5 trades, if they're right, will make me more money than 50 trades where I'm hoping, guessing, or forcing. Now let's talk about something that destroys more traders than anything else. Averaging down. Never average down. Only add to winners. This is where most traders destroy themselves. They buy a stock at 50. It drops to 45, and they buy more. I'm getting a better price, they tell themselves. It drops to 40, and they buy again. Now they're stuck, underwater, praying for a bounce just to get out. This is not trading. This is hoping. And hope is not a strategy. Here's the principle. If you're wrong, get out. If you're right, add on. When I pyramided, when I built positions, I did it only after the market had proven me correct. I'd buy at 50. If it went to 55, I'd add more. If it went to 60, I'd add again. I was buying strength, not weakness. I was compounding success, not averaging failure. Think about what this does psychologically. When you average down, you're telling yourself that your original thesis was wrong, but instead of accepting that and moving on, you're doubling down on the mistake. You're increasing your risk on a position that's already losing. And the deeper you go, the harder it becomes to get out, because now you need a bigger move just to break even. But when you add to a winner, you're compounding your edge. You're in a position that's working. The market has confirmed your thesis, and now you're using the profits from your initial position to fund additional risk. If it goes against you, you take profits on part of the position and get out. But if it keeps going, you've built something substantial. If I started today, I'd make this rule absolute. I would never, under any circumstances, add to a losing position. I'd cut it. I'd take the small loss and move on. But when I had a winner, when the market was confirming my thesis, I'd press. I'd let my winners get big, because one big winner can erase 10 small losses. But 10 small losses and no big winners will erase you. This is the mathematics of speculation. You don't need to be right all the time. You don't even need to be right most of the time. You need to be right on the big moves and wrong on the small moves. You need to lose small and win big. And that's impossible if you're averaging into losers and taking profits too early on winners. Let me tell you something else. Capital preservation is the foundation of everything. You cannot make money if you don't have money. That sounds obvious, but traders violate this principle every single day. They risk too much on a single trade. They go all in on a hunch. They blow up their account chasing one big score. I've made fortunes 4 times, and I've lost fortunes 4 times. But I never blew up completely because I always kept something back. I always preserved capital. Even when I was convinced I was right, I never bet everything. Because the market doesn't care how convinced you are. If I started today, I'd risk no more than 1 to 2% of my capital on any single trade. That means if I had $10,000, I'd risk $100 to $200 per trade. Not 1,000, not half my account. $100, because I need to survive 50 mistakes to find the 10 wins that matter. And if I'm risking too much, I won't survive. This is the part where people get frustrated with me. They say, "Jesse, 1%? How am I supposed to make money risking 1%? And I tell them, "You're asking the wrong question. The question isn't how do I make money fast. The question is how do I stay in the game long enough to learn how to make money at all? Because here's what happens. You start with $10,000. You risk 50% on a trade because you're convinced it's a sure thing. You lose. Now you have 5,000. You need to make 100% just to get back to where you started. So you take another big risk. You lose again. Now you have 2,500. Now you need to make 300% to get back to even. Do you see the problem? You've put yourself in a hole that's almost impossible to climb out of. But if you risk 1%, you can be wrong 50 times and still have half your capital. You have room to learn, room to make mistakes, room to develop your edge without destroying yourself in the process. And that room, that margin for error, that's the difference between becoming a trader and staying a gambler. Now let's talk about the real enemy. Emotion. The market will make you feel things. Greed when you're winning. Fear when you're losing. FOMO when you're on the sidelines. Regret when you're wrong. These feelings are designed to destroy you. They're designed to make you act when you should wait, and wait when you should act. They're designed to cloud your judgment, override your rules, and separate you from your capital. I learned to trade like a machine, not because I didn't feel. I felt everything, but because I didn't act on what I felt. I had rules. I had stops. I had position sizes. I had criteria for entry and exit, and I followed them, even when my gut screamed at me to do something else. If I started today, I'd write down my rules before I took a single trade. I'd define my edge. I'd define my risk. I'd define my exit before I defined my entry. And then I'd follow those rules like my life depended on it, because my capital does. Here's what most people don't understand. Your emotions are not your enemy. Your emotions are information. Fear tells you you're risking too much. Greed tells you you're getting ahead of yourself. Regret tells you you're not following your process. These are useful signals, but they're only useful if you can observe them without acting on them. This is the hardest skill to develop. The ability to feel fear and not run, to feel greed and not chase, to feel FOMO and not jump in, to feel regret and not revenge trade. This requires a level of self-awareness that most people never develop because they're too busy reacting to what they feel instead of observing it. If I started today, I'd spend as much time studying myself as I spent studying the market. I'd keep a journal. I'd write down what I was feeling before, during, and after every trade. I'd look for patterns in my behavior, times when I trade well and times when I trade poorly, and I'd start to see that my results have less to do with my analysis and more to do with my state of mind. When I'm calm, patient, and disciplined, I trade well. When I'm anxious, impulsive, or emotional, I trade poorly. And once I know that, I can start to manage my state instead of just managing my positions. I can ask myself, before I take a trade, am I in the right state to trade right now? Or am I trying to trade away a feeling? Because here's the thing. Most bad trades aren't bad because the setup is wrong. They're bad because you're wrong. You're trading to feel better about a loss. You're trading to prove something to yourself. You're trading because you're bored, or frustrated, or scared, or greedy. And none of those reasons will make you money. The market doesn't care why you're trading. It only cares whether you're right or wrong. And if you're entering a trade from an emotional place, you're almost always wrong. Now let me give you something practical. Something you can do right now. Stop trading for 30 days. I'm serious. If you're currently trading, stop. Close your positions. Step back. Spend the next month doing nothing but observation. Watch the market. Watch your watch list. Watch how stocks move, how they react to news, how they build bases and break out. Watch without the pressure of having capital at risk. This will do two things. First, it will break the dopamine cycle. You'll stop associating trading with emotional highs and lows. Second, it will train your eye. You'll start to see patterns you couldn't see when you were busy acting. You'll start to notice things. The way certain stocks lead their sector. The way volume dries up before a move. The way resistance becomes support. Things that are invisible when you're emotionally invested but obvious when you're just watching. And here's what else will happen. You'll start to see how often you would have been wrong. How many times you would have entered too early, or too late, or in the wrong stock. And you'll start to develop a healthy respect for how hard this actually is. How much skill and discipline it requires. How much work you need to do before you're ready to risk real money. After 30 days, you'll be a different trader. Not because you've learned some new strategy, but because you've learned to see. And seeing is the foundation of everything. Now, after those 30 days, here's what you do next. Define your edge in writing. You cannot trade without an edge. And an edge is not a feeling. It's a definable, repeatable pattern or principle that gives you a statistical advantage over time. Sit down and write this. I make money when blank. Fill in that blank. Is it trend continuation, breakouts, earnings momentum, sector rotation? Whatever it is, define it clearly. Then write this. I lose money when blank. Be brutally honest. Chasing, overtrading, revenge trading, holding losers. Once you've defined these, you have a framework. You know what to do and what not to do. And that clarity is worth more than any indicator. Because now you're not guessing. You're not hoping. You're operating from a place of knowledge. You know what works for you and what doesn't. And you can start to build a process around what works and eliminate what doesn't. This is what professionals do. They define their edge. They test it. They refine it. They build rules around it. And then they execute those rules with discipline. They don't trade everything. They don't chase every opportunity. They wait for their setup. And when it appears, they act. If I started today, I'd be ruthless about this. I'd define my edge so clearly that I could explain it to a child, and I'd only trade setups that fit that edge. Everything else, no matter how tempting, I'd let go. Because the market will always offer opportunities. But not all opportunities are your opportunities. Now let's talk about something practical. Build a pre-trade checklist. Before you enter any trade, ask yourself these questions. Is this aligned with my edge? Is the trend clear? Is this the right time? Or am I forcing it? What is my risk per share? Where is my stop? What is my target? Can I afford to lose this trade and still trade tomorrow? If you can't answer every one of these questions with confidence, don't trade. Wait. There will always be another trade. But there won't always be another account if you blow this one. This checklist does something important. It forces you to slow down. It forces you to think before you act. It creates a pause between impulse and execution. And in that pause, you can ask yourself, am I trading because the setup is right? Or am I trading because I want to feel something? Most bad trades happen in that moment when you bypass the checklist. When you see something moving and you just jump in. When you hear a tip and you act on it. When you feel like you're missing out and you chase. The checklist protects you from yourself. It makes you accountable to your process instead of your emotions. If I started today, I'd tape that checklist to my screen. I'd make it impossible to trade without seeing it. And I'd follow it religiously, even when it feels like I'm missing an opportunity. Because the opportunity I'm protecting is not the trade. It's my capital, my ability to trade tomorrow. Now, after every trade, win or lose, you need to keep a trade journal. Write it down. Not just the P&L, but the why. Why did you enter? What were you feeling? Did you follow your rules? What did the market do that you didn't expect? What would you do differently? This journal will become your textbook. It will teach you what you do right and what you do wrong. And over time, you'll see patterns in your behavior. Patterns that, if corrected, will transform your results. Here's what you'll notice. You'll see that you trade well in certain conditions and poorly in others. You'll see that certain types of setups work for you and others don't. You'll see that you make the same mistakes over and over, not because you're stupid, but because you haven't made those patterns conscious. The journal makes them conscious. It holds up a mirror, and once you can see what you're doing, you can start to change it. You can start to reinforce what works and eliminate what doesn't. You can start to become the trader you need to be instead of staying the trader you are. If I started today, I'd review my journal every week. I'd look for patterns. I'd celebrate the wins where I followed my process, even if they were small. And I'd analyze the losses where I broke my rules, even if I got lucky and made money. Because process matters more than results. Good process leads to good results over time. Bad process, even if it occasionally produces good results, will destroy you eventually. Now here's something that sounds strange, but hear me. Practice losing. Practice taking losses correctly. Take small positions, set tight stops, and let yourself get stopped out. Feel it. Process it. Learn that losing a trade is not the same as being a loser. It's just part of the process. The more comfortable you become with small losses, the less likely you are to let them become big losses. Because here's what happens. Most people can't take a loss. They can't accept that they were wrong, so they hold, and hope, and pray that the stock comes back. And sometimes it does, but sometimes it doesn't. And when it doesn't, the loss becomes catastrophic. But if you've practiced taking small losses, if you've trained yourself to cut quickly and move on, you'll never have a catastrophic loss. You'll never have that moment where you wake up and your account is gone, because you'll have cut the trade long before it got to that point. If I started today, I'd take 10 small trades with the explicit goal of getting stopped out. I'd pick setups that are marginal, set my stops, and let the market take me out. And I'd process the feeling, the disappointment, the frustration, the urge to get back in. And I'd learn that those feelings pass, that I can take a loss and still be okay, that my worth as a person is not tied to whether a stock goes up or down. This might sound like a waste of money, but it's not. It's tuition. It's the cost of learning to lose correctly. And learning to lose correctly is the most important skill you can develop as a trader, because you will lose. Everyone loses. The question is whether you lose small or lose big, and that's determined by your ability to accept a loss and move on. Let me tell you something about the nature of markets. Markets move in trends, but most of the time, there is no trend. Most of the time, the market is chopping, consolidating, digesting, and during those times, there's no money to be made. The money is made in the trends, in the big moves that come a few times a year. And your job is not to trade all the time. Your job is to identify when a trend is starting and ride it until it ends. This requires a different mindset than most people have. Most people think they need to be active. They need to be doing something every day. But the professionals know that most days, the best thing to do is nothing. Watch, wait, and prepare. And then, when the opportunity comes, act with conviction. If I started today, I'd focus on identifying trends, not predicting them, but identifying them once they've started. I'd look for stocks that are making higher highs and higher lows. I'd look for volume confirming the move. I'd look for breakouts from consolidation. And when I found those conditions, I'd get in and stay in until the trend broke. I wouldn't try to pick tops or bottoms. I wouldn't try to be clever. I'd just follow the trend. Because the trend is your friend until it ends. And it will end. All trends end. But while it's going, your job is to ride it, not question it. This is harder than it sounds. Because trends don't move in straight lines. They move in waves. Up, pull back. Up, pull back. And during those pullbacks, your emotions will tell you to get out. They'll tell you the trend is over. They'll tell you to take your profit and run. But if the trend is still intact, if the structure is still holding, your job is to sit, to hold, to let the market do what it's going to do. And this is where position sizing comes in. If you're sized correctly, if you're only risking 1 to 2% on the trade, you can withstand those pullbacks without panicking. You can give the trade room to work. But if you're over-leveraged, if you're risking too much, every pullback will feel like a crisis. Every wiggle will threaten to stop you out, and you'll end up getting shaken out of a winning trade because you sized it wrong. If I started today, I'd focus on position sizing as much as I focused on entry, Because position sizing determines your emotional state, and your emotional state determines your ability to execute your plan. If you're sized too big, you can't think clearly. Every move against you feels like a catastrophe. But if you're sized appropriately, you can watch the market with detachment. You can make decisions based on what the market is doing, not on what you're feeling. Now let's talk about something that will save you a fortune. The concept of the line of least resistance. Every stock, at any given time, has a path of least resistance, a direction it wants to go. Your job is not to fight that direction. Your job is to identify it and go with it. How do you identify it? You watch the action. You watch how the stock reacts to news. You watch how it trades in relation to its sector. You watch how it handles support and resistance. And you start to get a feel for which way the pressure is building. If a stock is holding support, bouncing every time it gets near a certain level, the line of least resistance is up. If it's failing at resistance, getting sold every time it approaches a certain level, the line of least resistance is down. Your job is to trade in the direction of least resistance, not against it. This sounds simple, but most people get it backwards. They see a stock that's been going down and they think it's oversold, it has to bounce. Or they see a stock that's been going up and they think it's overbought, it has to pull back. And they trade against the line of least resistance, and they get crushed. If I started today, I'd make a rule. I only trade in the direction of the line of least resistance. If I can't identify which direction that is, I don't trade. I wait until it becomes clear. Because trading against the line of least resistance is like swimming upstream. It's exhausting, it's inefficient, and it rarely works. Now here's something else. The market will teach you if you let it. Every trade you take, every move you watch, every mistake you make, the market is teaching you something. But most people don't listen. They don't learn. They make the same mistakes over and over because they're not paying attention to what the market is telling them. If I started today, I'd approach the market as a student, not a master. I'd assume that I have everything to learn and nothing to prove. I'd watch, I'd listen, I'd absorb, and I'd be humble enough to admit when I'm wrong and adjust. This is the difference between traders who make it and traders who don't. The ones who make it are constantly learning, constantly adapting, constantly refining. The ones who don't are stuck in their ways, convinced they know how it works, unwilling to change even when the evidence says they should. The market is always changing. What worked last year might not work this year. What works in a bull market doesn't work in a bear market. What works in high volatility doesn't work in low volatility. And if you're not adapting, if you're not learning, you're going to get left behind. If I started today, I'd spend time every week studying market history, not to predict the future, but to understand patterns, to see how markets behave in different conditions, to recognize when we're in a topping process or a bottoming process, to understand the psychology of booms and busts. Because the thing is, everything that's happening now has happened before. Not exactly the same, but similar enough that if you study history, you'll recognize the patterns. You'll see when the crowd is getting euphoric, and you'll know to be cautious. You'll see when the crowd is panicking, and you'll know to be greedy. You'll develop a sense for where we are in the cycle. And that sense, that intuition built on study and observation, that's worth more than any indicator or strategy. Because the market is not mechanical, it's psychological. It's driven by human emotion, and human emotion follows patterns. Fear, greed, hope, despair. These cycles repeat, and if you understand them, you can position yourself to profit from them. Now let me tell you about something that will change how you think about trading. The concept of probability versus certainty. There is no certainty in trading. None. You can never know for sure what's going to happen next, but you can operate in probabilities. You can take trades where the odds are in your favor. And if you take enough high probability trades, over time, you'll be profitable. This is a mental shift. Most people are looking for certainty. They want to know that this trade will work. But that's not how trading works. Trading is about managing uncertainty. It's about taking calculated risks, where the reward justifies the risk, where the probability of success is higher than the probability of failure, and then managing your position based on what the market does. If I started today, I'd think in terms of probability, not certainty. I'd say to myself, This trade has a 60% chance of working. If it works, I'll make 3 times what I risk. If it doesn't, I'll lose 1. That's a good trade. Not because it will definitely work, but because if I take enough trades with that kind of risk reward, I'll come out ahead. This also means accepting that you'll be wrong. A lot. Even if you're right 60% of the time, you're wrong 40% of the time. And that's okay. That's part of the game. The question is not how to be right all the time. The question is how to make more when you're right than you lose when you're wrong. And that comes back to position sizing, risk management, letting winners run, and cutting losers quickly. All the things we've talked about. These are the mechanics of managing probability. These are how you turn a statistical edge into actual profit. If I started today, I'd focus less on being right and more on managing risk. Because being right doesn't matter if you risk too much when you're wrong, and being wrong doesn't matter if you risk small and cut quickly. What matters is the overall equation. Are you making more than you're losing over time? That's the only question that matters. Now let's talk about something practical. How do you know when a trend is ending? Because that's the hardest part, right? You get in a trend, it's working, you're making money, and then suddenly it reverses and takes back half your profit before you get out. How do you avoid that? The answer is you watch the structure. A healthy uptrend makes higher highs and higher lows. As long as that structure is intact, the trend is intact. But when the stock makes a lower low, when it breaks that structure, the trend is over. That's your signal to get out. It doesn't matter why the trend is ending. It doesn't matter if the news is good or bad. The structure is breaking. That's all you need to know. And when that happens, you exit. You take your profit, and you move on. You don't try to figure out if it's a fake out or a real reversal. You just respect the signal and act. If I started today, I'd use this simple rule. In an uptrend, I exit when the stock makes a lower low. In a downtrend, I exit when it makes a higher high. Simple, mechanical, unemotional. It won't get you out at the top, but it will get you out with most of your profit intact. And that's all you need. The goal is not to maximize every trade. The goal is to extract a good profit from the trades that work and minimize the damage from the trades that don't. And this rule does that. It keeps you in while the trend is working and gets you out when it's not. Now here's the thing about all of this. None of it is complicated. It's all simple. Almost too simple. And that's why most people don't do it. They think there must be something more. Some secret indicator. Some hidden pattern. Some complex strategy that the professionals use. But there isn't. The professionals use the same simple principles that I'm giving you right now. The difference is, they actually follow them. They have the discipline to wait, the courage to act, the humility to admit when they're wrong, and the emotional control to let winners run and cut losers quickly. If I started today, I wouldn't look for complexity. I'd look for simplicity. I'd build a system that's so simple I could execute it under pressure. A system that doesn't require me to think too much or analyze too much. A system that just requires me to observe, wait, and act when conditions are right. Because here's what happens when systems get complicated. They break down under pressure. When your money is on the line and your emotions are running, you can't execute a complicated system. You'll forget a step. You'll second guess yourself. You'll make mistakes. But a simple system you can follow even when you're scared, even when you're greedy, even when you're emotional. That's the power of simplicity. It's robust. It's reliable. It works in all conditions because it's based on principles that don't change. Price action, trend, risk management. These are timeless. They worked in 1920. They work today. And they'll work in 2050. Everything else is noise. So let me bring this all together. If I started trading today, here's exactly what I'd do. I'd stop trading for 30 days and just watch. I'd define my edge in writing. I'd build a pre-trade checklist. I'd start a trade journal. I'd practice taking small losses. I'd focus on position sizing. I'd only trade in the direction of the line of least resistance. I'd let winners run and cut losers quickly. I'd never add to a losing position. I'd think in probabilities, not certainties. And I'd keep it simple. That's it. That's the whole system. It's not sexy. It's not exciting. It's not going to make you rich overnight, but it will make you a trader, a real trader. someone who can survive in this market, someone who can compound capital over time, someone who can withstand the psychological pressure of having money at risk. And here's what else I'd do. I'd be patient with myself. I'd understand that this is a skill that takes time to develop, that I'm going to make mistakes, that I'm going to have losing streaks, that there will be times when I doubt myself and times when I want to quit, and I'd keep going anyway. Because the thing about trading is that it's not just about the market. It's about you. It's about who you become in the process of learning to trade. It's about developing discipline, patience, emotional control, humility. These are skills that apply to everything in life. And if you can develop them through trading, you'll be better at everything else you do. If I started today, I'd view trading as a path of personal development as much as a path to profit. I'd use it to learn about myself, to see my weaknesses clearly, to confront my fears and my greed, to develop the kind of character that can withstand pressure and uncertainty. And you know what? That's the real reward. Not the money. The money is nice. But the real reward is becoming the kind of person who can make money in the market. Because that person, that operator, that disciplined, patient, emotionally controlled individual, that person can succeed at anything. So here's where we are. You're not broken. You've just been misled. You've been taught that trading is about finding the right stock, the right setup, the right moment. But trading is about becoming the right person, the person who can sit still when the crowd is frantic, the person who can act decisively when the crowd is frozen, the person who can lose small, win big, and sleep soundly either way. That person isn't born. That person is built, trade by trade, decision by decision, moment of discipline by moment of discipline. You're not here because you're greedy. You're here because you're curious. Because somewhere inside you, you know there's a better way to do this. And there is. It's not easy. It's not fast. But it's real. So, take what I've given you today. Write it down. Test it. Challenge it. Make it yours. And when you're ready, when the setup is right, when the conditions are clear, when you've done the work, step in. Not with hope, not with fear, with readiness. If you got something from this, leave a comment. Tell me what clicked. Tell me what you're struggling with. And if this made you think differently about the market or about yourself, hit that like button and subscribe, because we're just getting started. Now go. Sit still. Watch. Wait. And when the time comes, act.